Hello, my name is Neil George, and we are live at the Money Show in Dallas and also on Facebook. Joining me is Kelley Wright. He is the editor-in-chief for Investment Quality Trends.
I am, sir.
Thanks very much for joining us.
Thanks for having me.
Now, you and I basically always had a love of dividends. We like the idea of getting, when we're buying a stock, we want to get paid. We want to get paid regularly, we want to get paid in increasing amounts over time.
True.
The market right now has not really been, all that favoring of the dividend model. The overall dividend of the S&P 500 is under 2%.
Correct.
So you're barely above inflation, or you're basically right at inflation if you look at a core PCE index.
Right.
Now, there are opportunities out there.
True.
So where are some of the opportunities right now in the dividend space that are getting something a little more attractive?
Sure. Well, in my world, we use dividends for valuation, and we look for historically high dividends to give us an idea of when a stock offers good value. And it is pretty thin right now, but Philip Morris, okay, it's got a yield in excess of 5, which is pretty good. Public Storage, REIT, has a dividend. I believe it's around the 4.5% area.
Now, the REIT space came under a lot of pressure in the early part of the year. A lot of people sort of, I think, misread what was in the Tax Cut and Jobs Act and realized they're actually getting a benefit as a REIT.
Correct.
And so from February to now, we've seen the recovery.
True.
But of recent, we've seen the REIT space start to give back some of those gains.
True.
What do you think is behind that?
Oh, I think part of it is just that it's clear that the Fed is on a cycle of raising rates. The Fed's also taking money out of the market, like $70 billion a month. Okay, so I think that the industry's done a good job of training the investor to think that rising rates means bad news for things that are interest sensitive.
Right.
Okay, so. But I think if you look at the companies individually, and one of the reasons why I like Public Storage is they've got a one-time capital outlay. They build a box, they divide it into cubicles,
and you put it on a concrete slab.
Exactly. I mean, it's not very sophisticated, and they raise rents all the time. And if you don't pay your rent, then they take your stuff and put it on a reality TV show.
Another revenue stream.
Another revenue stream, but. It's a simple business with low capital outlays, and the demand for storage is off the charts.
It just continues to defy sort of a lot of expectations, even people in the industry.
Right.
And the other thing that I've always liked about this segment is that it's a great parking place for land.
That's an excellent note. That's true.
So if you have land in an ex-burb area,
sure,
and you don't have a development project plan, again, concrete slab, put boxes on top, start charging monthly rents, you're good to go.
And you can raise it.
Right.
You can raise it all the time, as opposed to, a typical fixed income or
a long-term corporate lease.
Exactly. They don't really have an inflation ladder built into it. And so the beautiful thing about storage is that, they can raise that rent, raise it all the time.
So you buy into that. The general economic trends in the U.S. are still, at least from my perspective, green light for further growth. And so that the idea that more cash flows means that the company has more pricing power to say. Your rent next month is going up X percent, the following month X percent.
There's some truths in our world, and one of them is that supply and demand is still one of the most important aspects of business. And the fact of the matter is there is a huge demand for storage space, and there's not really the supply to meet it right now. So it's just a great spot for them to be in.
I guess it's the same thing with residential real estate as well, because you're seeing that a lot of urban areas whereby the accessible housing and space and so forth. Perhaps I think some of them might be related.
I don't think it's coincidental. Sure, yeah, absolutely.
So beyond that, what other areas are you also seeing some great income opportunities?
It's pretty interesting. Like if we went back to the mid 2000s, and I looked at my universe of stocks in what I call the undervalued area, they were predominantly financials. Today in my undervalued area, there is no financials. There's a handful of staples, a handful of discretionary,
And that area really has been very much a disappointment in the marketplace.
Oh yeah.
A lot of the branded names they're seeing sales decline. Management, many of these companies, old line companies, are saying, we don't know what to do to fix our problem.
Yeah, someone in one of my earlier presentations today, someone was asking about General Mills. It's a fantastic company. I mean, it's a great company, but they are just languishing. Okay, Coca-Cola on a price basis is languishing. As is Pepsi.
Again, you look at there's tastes have changed, and a lot of the companies haven't necessarily caught sort of caught on, and you have some of the cost concerns with transportation is eating into profitability.
Yeah, and commodity-oriented businesses have always,
But yeah, in the space you've had some success stories with the turnaround. Mondelez, I think, has been showing some good progress with some of their shakeup. Nestle, I think, has been doing it. Has had some progress.
True.
So there is potential in this space, and as you've said, there's value there if we get the turnaround.
Right. You've got to be. Yeah, that's why I'm not a big believer in just looking at sectors. I'm a bottom-up guy. I like to. I never have a top-down view. I never have like this macroeconomic view and then try to pick the sectors and things, from the top down. I'm just a bottom-up guy, and when things fall into, it doesn't matter to me what the sector is, what the company does, for that matter. But as long as it offers good value vis-a-vis its dividend yield, then I'll buy it.
So what has been one of your more recent stumbled upon values right now?
What's really interesting, and this might have some political overtones, is Whirlpool. Whirlpool is a classic consumer discretionary stock.
The result of the merger with Maytag some years ago, which had a lot of political opposition, some of the union reps, and some of the...
And there's some of the China, the tariff stuff. That's been kind of, I think, problematic for them, because Whirlpool, even 6 to 8 months ago, was a high flyer, and they've come down. If you take a look at, what's interesting is the mutual fund industry. Okay, take a look at a company like Franklin Resources. Okay,
it's all about assets under management, collecting those fees.
Exactly. And as you probably know, mutual funds are going out of business because ETFs are taking over the world. But when allegedly, right. That's tongue in cheek, folks. So when you look under the hood, though, I mean, the return on invested capital at Franklin it's over 20%. The free cash flow yield is close to 20%. Okay, yeah. Wall Street has them priced as if their earnings is going to decline 30% from their
into infinity at that point.
Absolutely,
they're just going to run themselves down.
Exactly, and if you know anything about math, a company that has that type of return on invested capital, which is a number you can't fudge, it is what it is, and free cash flow is what it is, you can't fudge those. If you have those type of numbers, it's inconceivable that the company's going to go out of business. They have real earnings, they're making real money, so,
And again, what people don't realize is that within that space is that even if you are running, a portfolio of ETFs, even at a reportedly near zero fee structure, there's still a lot of streams of income that are coming off of those underlying assets.
Very true. And here's the thing that I don't know. This is just my personal opinion, but I'm kind of curious that you've got this generational dive into the passive market. And it's worked because we've had an unusual cycle where you had a very activist Fed that created an environment that made it great for passive investing. You didn't have to be smart, you just had to be in.
And that time is very well be changing at some point.
One would think.
Well, Kelley, thanks very much for joining me. Kelley Wright joining me. I'm Neil George. We are live at the Money Show in Dallas, Texas, and also on Facebook. Thanks for watching.